Here's what I decided to do. After Tuesday's class, I said, well, look, let me make sure that everyone is up to speed. There are people that do come to office hours, and they do ask me questions. So I thought I'd put together a comprehensive problem. Now, this problem is everything that you should be able to do as of right now. So you don't have the slides. I'll post them at some point. You don't have the slides. You will get them. Well, let's just see, and I'm going to call out some people to make sure we know how to do these transactions. All right, so the first in this set of transactions asks us to record the following. You received and by the way, what we're going to do is I'm going to spend a little bit more time on this. It doesn't bother me to use class time for something I think you really need. So we're going to spend class time. We're going to do the journal entries. We're going to do the posting to the T accounts. And then we're going to do the trial balance and then the financial statements. All right, so let's do the first one. It said that we're paying or received a $20,000 contribution from Thomas in exchange for common stock. So let's see, Carol, where'd you go, my friend? Guy looking for extra time. Did you leave? Oh, there you are. Okay, so how would you record that? This is on the 2nd, July 2nd. He says cash debit 20. Common stock, you do what with that one? Credit. Okay, so his answer is you're going to debit cash, credit common stock, and then you would post that to the, I'll put that up on the screen. So, let me come back a little bit with this. Okay, so that, all right, there you go. So he's correct. All right, so he's correct. Gets a nice check plus for participation. Okay. All right. So there's your answer on that one. So now you're starting to build up your T accounts, right? So now you're going from the journal to the ledger. Now during office hours, there were questions about posting. If there was a posting reference here, I would put the account number next to the journal. So if you're looking at if there was a posting reference, let's say cash is account 101 and common stock is account 450 or 500, let's say. Okay? So if those were the account numbers, and if this was journal, page 1, you're looking for a cross-reference. So what you would do here is when you do a posting reference, the posting reference would say what account is cash. Sorry, it's 101 after I post it. And after I post it to common stock, I would put down account number 500. Here, how would I trace it back to the general journal? I'd have to have a page number, and the page number would be here. You'd have a posting reference, and that posting reference would be journal page 1. And here you'd have a posting reference, and that would be journal page 1. All right, so anyone with any questions on the first entry? I'm going to go through these. There's only a few of them. We spend, half hour, 40 minutes. I need to get everybody up to speed. If you're not, after we do this, if there's lots of things you don't understand or can't do, make sure you make appointments with us during office hours, and we want to straighten this out before exam 1 on October 1. Okay? Anyone with any questions here? Yeah. No, in class. Okay. Any other questions? Yeah. Question. Let me make sure you had this. Good. I should have given you a mic. Yeah, just ready. Project your voice. Hold it down, please. Yes. No, what you would have to do, it's a good question. If you're doing a problem like this, you would have to know the journal page number. So you're on page 1, so you'd know that's page 1. You'd also need to know the account number. Where do you get the account numbers from? Chart of accounts. All right, so there would be a chart of accounts. So you would, let's say you were at, you were doing a systems analysis, or you were an accountant, or whatever you're doing, you'd have the chart of accounts up front. So I would know the account numbers. So I'd be able to trace them through, okay? Now, you're worried about an exam? Yeah, you'd have to have a chart of accounts on an exam, otherwise you couldn't do this. Yeah, question?
You have to make your own chart? Or
No. Oh, you mean to say in terms of, well, don't worry about the exam. I'll talk about the exact exam later. So you're talking about, do you have to make up T accounts and things like that? No, we'll talk to you about that. All right, any other questions on the first journal entry? Okay, let's go to the second. We paid utility expense. We paid utility expense for 800. Utility expense for 800. Let's say on Jason. I'm going to get Jason Unger. Yeah, good. Okay, how would you handle that one? Yeah, that's right. Right. Okay, correct. So the and then of course you post it as well. So this one, let me get this up on the screen for you. Come on, there you go. All right. So this would be a debit to utilities expense for 800 and a credit to cash for 8. And then, I'm not going to do the posting references. When you post them, then you'd have the debit going to utilities expense, the credit going into cash, and then of course, right here, if I wanted to take a balance at this point, I know I've got $19,200 in cash. And just like your checking account, every time you expend cash or you write a check, you're going to wind up with, you want to know your balance. So it's exactly the same way. All right, so any questions on transaction 2? So what I'm doing is I'm building up the T accounts, then I'm going to do the trial balance, and then the financial statements. And that, by the way, is, again, the accounting cycle summary. I want you to understand the entire cycle up to this point. Okay? Any other questions? All right, let's go to the next one.
You have to do a balance after each transaction?
You should, yeah. Good question. Do you take a balance after each transaction? Probably a good idea. Okay. All right, and of course, if you use the very formal, if you remember the very formal accounts that we have, those 4-column accounts, it forces you to use a balance. Correct? Okay. All right, so let's do the next entry. I want to know how you would handle purchasing. I'm sorry. Oh, okay. Now I'm just calling people at random. But if you want this one, good. All right. Okay. The answer that was given is that you would debit the equipment account and you would credit accounts payable, and that is correct. So what you would have is, if you check the doc cam again, you're going to have a debit to equipment and a credit to accounts payable. Now, more likely than not, for equipment, would you use an account? Maybe for that amount, but huge pieces of equipment, you're going to use notes payable, probably. Okay. And then, of course, the equipment account is debited after you post it, and, of course, the accounts payable is credited after you post it. Questions on that one? Again, a lot of things at work. You have to know the rules of debit and credit. You have to know how to make a journal entry, and you need to know how to make the posting entry. Yes? Yeah. Sure. Okay, it's a good question. You purchased a computer and a printer. Why wasn't it office supplies? I mean, today, computers and printers are not all that expensive, and they don't last all that long. They're a couple of years. So some businesses may actually call them office supplies, but for us, we're looking at printers and computers as office equipment, and we'd look at things like, pens, copy paper as supplies. So supplies would be less material, less significant than the equipment. A very good question. Okay. All right. Any other questions before we move ahead? Let's try the next transaction then. The next transaction tells us that we have a service performed for a client on account, and that is for $4,000. So for this one, let me get Tina Cara. Tina, are you around anywhere? Tina? Don't want to raise your hand? Okay. All right. Let's go with David Choi. Is he here? And these are participation credits. Right? Is absent? Oh, okay. Yes, you are. Okay. Luis Torres will step up. Okay. All right. Yeah, very good. Okay, so she is correct. So the answer is you debit accounts receivable and credit service revenue. And again, service revenue is what type of an account? It's a revenue account, but it also affects what account? Stockholders' equity through retained earnings. So we'll get to that eventually. All right. Questions? Everyone okay with that? All right. What about the next one? All right, next one says they borrowed $14,000 in cash by signing hold on that one. I'm going to $14,000 in cash by signing a notes payable. How about Diego Hernandez? Diego, yes. Credit. Very good. That's correct. Okay. So he said, which is correct, you would debit cash, you're borrowing money, sorry about that, debit cash, and you're going to credit notes payable. Now, again, when you look at the cash account, right now you got a balance of $33,200 because, again, this is transaction one. You debited for the investment, you paid the office supplies, and then you have the $14,000 on the borrowing of the note. Amir?
How come, like, for example, on the homework sometimes it says with an interest of this much, how come the interest doesn't matter?
The interest on this? We didn't get interest accrues over time. So unless it's given to you in the problem, I mean, technically, at the end of the month, if you're preparing financial statements, you should have interest. So he brings up a good point. A lot of the problems do not take you through an entire realistic transaction, so there should be interest on that note. All right, any other questions? And make sure you understand that you want to get that cash balance up to date, or any balance up to date. Yeah.
Is there a reason why it says, like, open for business?
Yeah, I mean, those are, when you look at those transactions, let's say signed a contract or opened the business or spoke with a customer or hired a new employee, those are designed to make sure you understand the idea of the fact that that's not a business transaction and you wouldn't record it. So sometimes those are more distracting than anything else. That's a good point. All right, let's do another one. All right, so now we borrow the money. Now we have cash dividends. So we've got dividends paid of $1,000. So these are dividends that are paid to shareholders. These are distributions. All right, so I have a volunteer again. Okay, so debit dividends and credit cash. Okay, so see that one? Oh, shut it off. Not good. There we go. There you go. All right, so you debit dividends, credit cash, and then once again, you got the cash balance being built up. Dividends have a debit balance. The debit balance on dividends does what to retained earnings? Lowers it. It reduces retained earnings. You just have to remember, dividends are not expenses. Dividends are distribution of retained earnings. All right, 2 more to go. And on this one, we have office supplies purchased for cash. And again, Deanna, you had a question about the difference between office supplies and equipment. Equipment would be something more durable, more long-lasting, so it might last 2 or 3 years. And office supplies would be something like copy paper, pens, staples and whatever else you use in the office. Okay, Ian, you want to take that? Okay, so you purchased office supplies and you debit that for 16 in credit cash. Okay, so, and again, there's your entry. Got to debit to office supplies. Remember, I'm not going through all the details, but if you did have to make a journal entry, you have to make sure you have the date, that the debit goes first against the margin and the credit is indented. And now when you post that, office supplies has a balance of $1,006, and you also have $30,006 as your balance of cash at this point. Okay. All right. Sounds like we're doing pretty well. So let's do one more. And this last one. Oh, I'll get you. Yeah, I know you want to do that one. Okay, so now you paid the liability from July 5. So July 5 is here, and it's a $2,400 liability. So how would you pay it off? Okay.
And then on cash you debit.
Very good. Yeah. So this time you're paying off the liability, and you're going to have the debit to accounts payable. Notice what happens to accounts payable now. You've got a zero balance, right? So now you zero that out. You have nothing left on the accounts payable, and the cash balance is $26,400. So that is our last transaction for the month. Now, the way this works, again, you're going to have, and I'm not saying, test-wise, but this is what you would be expected to know as of today. You get series of transactions. You journalize those transactions. You post them to the ledger. The journal is the book of original entry in chronological order. Then you post them to the ledger. The ledger consists of T accounts right now, and those are the balances of your accounts. The next thing we would do is to create a trial balance. Yes? That's the normal balance. That's a good question. Just from like a bad habit that we eventually develop is that we know that liabilities normally have a credit balance. So I would normally look for the balance to be zero, and I would normally look for the balance to be on the credit side. So liabilities have a normal credit balance. All right. Now, the next thing that you would do is you would have to come up with the trial balance. Let me bring this up, or at least let me show you the summary. So what I'm going to do next is show you where we stand with all of our accounts. So if you kept track of all of these T accounts, this is your general ledger. So once you finished all your journal entries, now at the end of the month, this is your general ledger. The ledger is a group of accounts, and these are the balances. Cash is $26,400, accounts receivable is $4,000, office supplies is $1.6, equipment is $4,200, and those are the balances that you have. And again, I will post this. I just didn't want to have it in front of you today, because I wanted to make sure you sort of took some notes, paid a little bit more attention, and answered some questions. And then, of course, you'd have the accounts payable with the zero balance. You've got notes payable with $14,000. Common stock has a $20,000 balance. And by the way, let's go back to that point you just made about the normal, or at least getting to the point of normal balances. You're looking at this, and you have to be sure you understand that, okay, accounts payable is a normal balance of a credit. You've got notes payable with a normal credit balance. Common stock has a normal normal credit balance. Dividends, a normal debit balance. So this is what you would expect to see. And then finally, you're going to have your revenues and expenses as you go to the end of the general ledger. So that sales revenue has a normal balance of $4,000, and of course there's a credit balance for revenue. And utilities has a debit balance. Its normal balance is a debit, and it's 8. Yes. Okay. difference between account and notes payable. When you look at, and go back and look at some of the earlier notes or text, an accounts payable is an open trade account, which means that I can make a phone call or go online and just type in information and I could buy something. I don't have to sign anything. They just have some information. It's an open credit, open trade account. So that businesses will just make a phone call or send an email and say, look, I need 25,000 units of this product, and they send them because you have an account with them. There's nothing signed. If, however, I'm buying a fleet of vehicles, like trucks, I'm going to have to go in there and sign a note. And a note is a formal document. You have to sign it. The interest rate is stated on the note itself, and it has a due date or a maturity date. So it's a much more formal document, whereas the account is more informal. And the account is 30 days generally. A note could be up to 5 years, 15 years. A mortgage could be 30 years. What is the... If you pay with a check, that comes out of cash, as far as we're concerned. No. Okay. All right, so now what's our next step? You have all these ledger accounts. We want to prepare financial statements, correct? Trial balance, right. So now you have to go from journal to ledger to trial balance to financial statements. If you remember the last slide with that little circle of sort of like the steps. So we want to prepare the trial balance, and this is what it would look like. All a trial balance represents is going to be a listing of the accounts in their debit and credit columns. Now, where do you get the information from? It's going to come from the general ledger. So if you go back to the ledger accounts, and I'll just give you an idea, again, so you see that cash is 26.4, and accounts receivable is 4. This is how you build a trial balance. You take the debit balances first, and then the credit balances. So you start with cash of 26.4, accounts receivable of 4, office supplies 16, and equipment of 42. You take those and you put them back into the trial balance. Trial balance is a listing of all accounts in debit and credit columns. All you're trying to do here is to make sure that debits equal credits. I mentioned on Tuesday, it does not prove the accuracy because, for example, when we had the account of, the sale on accounts receivable, the accounts receivable was a transaction for $4,000. What if I entered that as $40,000? Would the trial balance still balance? Well, what if I debited accounts receivable and credited sales for $40,000? Yeah. Is the transaction incorrect? It's incorrect. It's wrong. But the trial balance still balances. So the trial balance is not proof of accuracy. It is simply going to ensure that debits equal credits. Now, from the trial balance, you're going to prepare the financial statements. Any questions on the trial balance? That's at the end of the month of July. Yeah, Neil?
Is it always in asset liability?
Yeah. They're listed. The question is, are they listed in that order? Absolutely. In fact, we're not getting involved with too much bookkeeping because I know it's more than enough for someone that's a management major or marketing major. But if you took a real true bookkeeping course, all of these accounts would be listed with their account numbers, and they would tie back to the chart of accounts, and you list them in account number order. All right, notice also that retained earnings here is 0. All right, so retained earnings is 0. All right, now what's the first statement that you would have to prepare? What's the order of statement preparation? Income statements first, second, retained earnings, third, balance sheet, and then cash flow, which we're not going to see for a long time, thank goodness, right? So we're just going to stay with the income statement, retained earnings statement, and then, of course, the balance sheet. All right, so let me go to DocCam again. Oh, what happened? There you go. There it is, okay. What I want to do is, of course, where are my income statement accounts? What's going to go on the income statement? Let me get someone else. Anyone? Yeah, good. That's it. Just revenues and expenses, no dividends. So the only two accounts that are going to appear, and as I said, I wanted to keep this simple. It's going to be sales revenue and utilities expense, and the net income is going to be 32. All right, so your net income for the year is 32. Again, Mir brings up a good point. We didn't have any interest on the note. All right, we're ignoring taxes. There's lots of things that we're ignoring just to go through a very simple example. But again, you've got revenues minus expenses. Okay, that's the first step. No dividends, just to be sure again. All right, next. Let's go back to the trial balance. What I want to do after that is to prepare the statement of retained earnings. Now, in these basic examples, it's kind of unusual, but we start with a zero balance of retained earnings. So you're always going to have, in reality, the ending balance of one year becomes the beginning balance of the next. So as you start to build years and years of business, at some point, that retained earnings got to be positive, and I'll show you that in a moment. But right now, how would you build your retained earnings statement? It would be beginning retained earnings. How does retained earnings go up? Net income, revenues, and expenses. How does it go down? Dividends or a net loss, but dividends. So in our example, we're going to have very simple statement of retained earnings, and that is beginning retained earnings happens to be zero in this example. You have net income for the month, $3,200. You paid $1,000 in dividends, and the ending retained earning balance is 22. Now that is needed to balance the balance sheet, because the balance sheet will not balance without that number. Another thing to note, the balance of retained earnings on July 31st of 2014 becomes the beginning balance of retained earnings when? August 1st. August 1st. So balance sheet accounts, cash, receivables. Remember, I was using lots of terminology in the first couple of sessions, and I'll go back to that. It was there for a reason. I said that balance sheets are permanent accounts. They are cumulative. They build up year after year or month after month. So you have to remember the balances will continue. So the balance of retained earnings will carry forward for the next accounting period. Are there any questions so far? Is anyone uncomfortable? Have any questions? Yes?
So if you were to do another statement of retained earnings, it would say retained earnings
August 1st.
2014, and it would say 2000.
Exactly. So the question is, if I now decided to start or if I brought you another month and I get you at August 31st and I want you to come up with the retained earnings statement on August 31st, your opening retained earning balance is going to be 22. Exactly. All right. Last statement. Yes, go ahead. Sure.
Okay, so
Joanna,
for
correct?
August,
Joanna?
Yeah.
Yeah, okay.
The salary for August is 2,200, right? Do you subtract the net income from that, or do you add it?
No, you had it. So, all right, let's take this where we want to go with it. So, all right, so here's what we want to do. We want to come up with and that was, how much was that again? 22, right?
Is it supposed to be July or August?
What's that?
For retained earnings?
Yeah.
It's August?
August 1st, July 31st. So what happens here is that July 31st becomes August 1st, right? And that's where it would start. Now, what if you had net income of $5,000 in August? You'd add it. You add it. Yeah, so what happens is we're assuming, again, I'm answering a question, and a very good question, is how do you go to the next month? So I would now say net income, and I'm just making these numbers up, but let's say it's 5,000. And then let's say you had dividends of another 1,000. Every month you give $1,000 to your owners. That would now be retained earnings, and that would be 62 and that would be as of August 31st, 2014. And that would be your September 1st balance now, as it goes to the next month. Okay, so they just keep building month after month. Okay, so good question. All right, any other questions? Okay, now, so let's now take our last statement, which is our balance sheet. And our balance sheet accounts will include cash, accounts receivable, office supplies, and then equipment. Our liabilities, of course, accounts payable is 0, notes payable is 14, common stock is 20, and now, of course, you need retained earnings to balance. So the retained earnings balance on the trial balance is not going to help you. You have to get it from the statement of retained earnings. That's where it's got to come from. So if you are now preparing for the balance sheet, that's it. Now, how did I list them? Remember, how do you list assets? Order of what? No, liquidity. Liquidity. So the most liquid asset, just happens that cash happened to be large here. It's the order of liquidity. What does liquidity mean? It means the ability to convert to cash with minimal risk of loss. That definition is around somewhere in one of the lectures. So it is the ability to convert into cash with minimal risk of loss. Cash comes first, then receivables, then office supplies, and the least liquid is equipment. It's harder to sell a piece of machinery than it is to sell a receivable or a box of copy paper, for example. Yeah.
You just got retained earnings in the trial balance?
No, retained earnings is in the trial balance, and it just happened to be 0 in our examples.
Okay.
Right. That's why I said it's unusual. So now the trial balance for next month will have a 2,200 retained earnings balance in there. Yep. Yeah, Brianna?
Accounts receivable and asset. If the asset is something that you can make liquid like today, but accounts receivable you might not have it on it.
Yeah, accounts receivable, why is it an asset? You have the right to collect that. In the event, we'll see this later on in the semester, in the event that there is a probability that you will not collect the entire amount, we reduce it. And you may even write it off, you turn it over to a collection agent, whatever you have to do. So right now, that number on the balance sheet reflects what we expect to collect, reasonably expect to collect in cash. It's a claim to cash. Remember, assets are economic resources that have a probability of cash flow in the future. Right? So and now office supplies, again, office supplies are very much like prepaid services in a way, right? Because you've already paid for the supplies, and as you use them, you don't have to buy them again. All right, now, how do you list liabilities? In the order of maturity. So the current, right now, as we answered your question before, an accounts payable is probably 30 days. The note could be 3 years. So you would expect, I know the payable is 0, you would expect to pay off the liability for accounts payable first, and then the note. And then, of course, in stockholders' equity, you got common stock and retained earnings, and of course, that is going to be pretty much the order is that common stock comes before retained earnings. And then, of course, the balance sheet balances, so that, let me just bring it up on this screen for you. So that you have to make sure that your total assets, 36.2, equal your total liabilities and stockholders' equity. All right, so any questions with anything? Yes?
Another question about
Accounts payable.
When do you need to write 0 and when you don't?
Oh, I just put that there to make sure you know that the order in which you would show it. I would say I would probably leave that off the balance sheet right now. I would have left that off. What I want you to see the order in which it should be listed.
Sometimes we need to write zero.
Yeah.
My accounting back.
Yeah. I'm looking into that. I would say if it has a zero balance, write zero. It's the best way to do it. All right. Any other questions? Yes, sir. Okay, unearned revenue. Why is it a liability? Let's think about the scenario for unearned revenue. Unearned revenue means that you collected something before you actually did anything. So if I paid you today $5,000 to do consulting services, management consulting or computer consulting for me, you have my $5,000, but you've given me nothing. So you have a liability to perform services. That's why it's an obligation, a liability. No, what it would do is, how would you record, somebody help me record an unearned revenue. Let's take that example. You got a $5,000 contract. So what happened is that you collected $5,000. Okay, sorry. Yeah, how would you handle that? Right. Yeah, no, you. Yeah, sorry. Right, you credit the unearned revenue. So to answer your question, when you collect it, okay, so you would debit cash and credit unearned revenue. Now, the question you had is a good one. We're going to get to that in this next chapter. When is the revenue recognized? When you perform the services. What would you do if you provided $1,000 worth of work to me? You've earned what? $1,000, and that liability is paid. So how would you, this is a bonus question, not that you're going to get any points, but get in, yeah.
So you would debit $100,000 and then credit service revenue for $1,000?
Right, so the question again is, what do you do if now I owed you $5,000 in services, but now I delivered $1,000? That liability is now paid with services. So what was unearned is now earned. So if you do provide, we're going to do this in the next chapter. And there's your answer. Okay? So that's the way it would work. You have a liability until you provide service. Yeah.
Why do you have to put like an explanation underneath? Like if you know that
Yeah.
debit,
It's a good question. Yeah, why would you put an explanation underneath it? Normally, as you move along, if you take another accounting course or an advanced accounting course, you don't put explanations anymore, because if you know the subject well enough, you could pretty much understand what we're doing here. But initially in the beginning, we always put the explanations. Yep, not necessary in all cases. Yes.
So unearned revenue is right there, that's getting debited, right?
Yeah, you're debiting that. Yes, you're removing it. All right. So, any other questions on the accounting cycle? This is where you need to be today, and if you're not there, please get there quickly. You can get there quickly by making sure you see us during office hours, ask us lots of questions, and stay on top of the material, because now we have to move ahead at some point. And we're going to do that now. So let me now start. We're going to start in chapter 3. And I will hold down, and I will post that other example online for you. I'll post that other example online. All right, now in chapter 3, we're going to get exactly where we were with respect to the. We're going to get to the question that was asked a few minutes ago regarding the adjustment process. Now, in this chapter, we're going to be looking at a couple of different concepts. One of them is cash versus accrual accounting. And cash accounting is something that we think of all the time. That's the way we run our lives, is on a cash basis. The way you have to think now is on an accrual basis. So the two approaches, as we said, are cash and accrual. Cash basis focuses only on collections and receipts. Cash basis means that you recognize revenue only when you collect cash, and you recognize expenses only when you pay it. Very, very similar to the way we think as individuals. That is not necessarily the way businesses will operate. The businesses will operate on what we call an accrual basis, where we're worried about revenue and expense recognition and not necessarily concerned with the actual amounts of cash receipts and disbursements. We try to recognize revenues and expenses at the point economic activity takes place. So we're more concerned with the economic activity rather than the cash collection. So I'm going to give you go back to that illustration we just had. If you collect money and do nothing, it's not revenue, because there's no economic activity. If you perform the service, then the revenue is recognized. So we're not concerned with cash receipts. We're not concerned with cash disbursements when we think about revenue and expense recognition. So the accrual basis is required under GAAP. And again, it does measure economic activity. It is required under generally accepted accounting principles. And of course, the cash basis is not permitted because it is a violation in the sense that it does not measure your economic activity. And by the way, you're going to see as we go through, and I know we had like lots of discussion about, the impact of accounting on financial statements, the impact of accounting on stock markets. And if you think accrual accounting is bad, cash accounting is even worse, because you can control cash accounting even easier. What if you didn't want to pay, now don't do this, but this is on tape, by the way, but what if you didn't want to pay tax on a consulting business? So you're my consultant, and you did work for me. Now it's the opposite. You did $5,000 worth of work for me this year, and it's December 1st, and you tell me, you know what, I'm not going to send my bill until January 1st of 2014. For tax purposes, if you're on a cash basis, you don't have to report that until when? 2014. So you can manipulate earnings by timing receipts and payments. For example, if I wanted to accelerate expenses, I just go out and buy more supplies, right? Or pay my utilities in advance if I'm on a cash basis, or pay my rent in advance. So if you're on a cash basis, it doesn't measure economic activity. It just measures when you spend money and when you receive money. And again, that's not what we're trying to do in accounting. So to summarize, this is a good page for summary. It tells you that, again, we want to record revenue under the accrual basis. That's the way it should be. So if you go to your right, recognize revenue when it's earned, recognize expenses when they're incurred. In fact, we're going to look at some principles in just a minute of revenue and expense recognition. And then, of course, GAAP requires that you use an accrual basis. There are a couple of exceptions that you'll see somewhere in practice, but for our purposes, it's the accrual basis. It will measure economic activity, and that's why we have to use it. We're going to look at three concepts in just a minute: the time period concept, the revenue recognition concept, and the expense recognition concept. And those three will be the way we guide revenue and expense recognition. On the other side, of course, the cash basis, you only recognize revenue when cash is collected. You only recognize expenses when cash, of course, is paid. And again, it is not permitted under GAAP because it doesn't measure economic activity. It only measures the timing of cash receipts and disbursements, which I said that could result in manipulation of earnings. So let's be sure. I'll ask you a couple of questions on this, and then we'll move on to some of these concepts. So let's take a look at a couple of questions to make sure you understand cash versus accrual. And the first one tells you that Recipes, Inc. purchases 2,000 of supplies on account. Under the accrual basis of accounting, no entry is made until, of course, the account is paid. So let's just see if we have any questions on this. This should be easy. Some of these are very easy. So we want to know Recipes, Inc. They buy supplies on account. Now, let me just make sure I know it's easy. I think it's easy. But if you ever need to think like really hard on these things, make some journal entries. Make a journal entry. Figure out the way it should have been recorded and determine how it fits into that category. Okay? All right. Oh, come on, 15%? All right, look, this is should be easy. This one, if they purchase $2,000 of supplies on account, under the accrual basis, they're going to make an entry. What's the journal entry they're going to make? They're going to debit office supplies, and they're going to credit accounts payable. So the answer is going to be false here, so that you would have made an entry, okay, under the accrual basis. So even though you didn't spend any money, you still have to record the acquisition of supplies. All right.
How would you record that?
Debit, it's going to be a debit to office supplies and credit accounts payable.
Isn't that what you would do for cash anyway?
No. Cash basis, you would, if this was a cash basis, you wouldn't record anything until you paid it. All right, so, well, here's a good question. Now, think about this. If this was the cash basis, you would record nothing until you actually paid for those supplies. Okay? And a lot of us think that way. We start charging stuff, right? And then, hey, it's not really an expense until we have to pay for it. So, yeah. So the cash basis entry would not take place because you would wait until you paid it. Good question. All right, now the next one, I'll just tell you the answer to this one is B. This one should be pretty obvious. You recognize revenue when the service is rendered, even though the cash is not collected. Okay, let me see if we, okay. All right, this one, let me read this one out. If you have it with you, I hope you could see it. I know it's kind of small. I'll read this. It tells you that a company receives a payment on August 5th for services rendered 2 weeks earlier from one of its customers. So now you're receiving cash collections. Which entry would be recorded if the company used the cash basis? So very simply, you collected $5,000 for work you did a couple of weeks ago. How do you record it under the cash basis? In A, do you debit cash, credit accounts receivable? In B, do you debit cash, credit salary expense? Debit salary expense, credit cash. In C, do you debit cash, credit service revenue? And in D, do you debit supplies and credit cash? Okay, let's just see again. Assuming hopefully you have this in front of you. I'm sorry it's kind of small, but I can't make it larger. All right, so again, if this is the cash, all I want to know is what's the entry if this is the cash basis. You did, the idea is you provided service 2 weeks ago for somebody on account, and now they paid you. So the question is, when you collect it, how do you record it? All right, another round, so split. Okay. All right, on a cash basis, you debit cash and you credit service revenue. What's the entry if that's an accrual basis? Bonus points. Okay, what do you got? What would it be? Yeah, it would be, you said what? A, yeah. If it was on an accrual basis, it would have been A. So for those of you that answered A, that's the accrual basis, where you debit cash, credit accounts receivable, because you book receivable when? when you perform the service, right? When you perform the service. Okay. And that, by the way, is the answer to the next question. So the next question is the same. It's the same scenario. I'm not going to ask you this one. It's the same scenario, but they want to know, now you're on an accrual basis. If you're on an accrual basis, it means that in the month that you provided the service, you had a entry made to record the sale. So let me make sure, and the answer is A to this one. Let me make sure you see that. So the way this works is that you had all right, so then bring this up a little. All right, so let's see what happened. In the first, what was it, 2 weeks ago? 2 weeks prior. You provided service, no entry. Here, you would debit accounts receivable, and you credit service revenue. So the idea is that, and it's for 1,000, correct? So the concept of the accrual basis is that you recognize revenue when the service is performed, regardless of when the cash is collected. So now, I'll get your question in a second. So now, when you collect, you debit cash, if it's the cash basis, for 1,000, and you credit service revenue. But here, you would debit cash and you credit accounts receivable. All right, so Joanna, is that?
Yeah.
Okay.
So they can afford to do like this.
Oh, let me move that. I'm sorry, let me move that up. It could coincide. So I think what you mean by hand in hand is it mean that if you do work today and get paid today, then they're the same. Yeah, cash and accrual basis could be the same. Brianna? Oh, Brianna.
So say you're doing like an external report for an investor or something, they're going to see both the cash and accrual?
No, only GAAP. GAAP is the only accrual is only allowed under GAAP.
So, but to them, wouldn't it look like you don't have any money, like that you?
Yeah, that's when we. Okay. Yeah, I'm going to repeat the question. So the question is, if you're doing a report for a stockholder, you use the accrual basis. Now, does it look like you have no cash? Yes, there's no cash flow on that transaction. That's why you prepare a cash flow statement. If you remember the cash flow statement would show that there's no cash flow 2 weeks ago.
What about liabilities?
For a liability, the same thing. If you, on the other side of this transaction, the person that received your services, if it was a cash basis, they would have had no entry at all under cash. Under the accrual basis, they would have debited an expense and credited accounts payable. Yes, Amir? Yeah.
Why is it that the question said that 2 weeks earlier to one of the customers on account? So that's what
Accounts payable, or accounts receivable, I should say.
But then you never use that for the cash. Like for the cash basis, you never use accounts.
Well, that's right. That's right. So the question is stated that the transaction was on account, showing you it had no cash. Again, a lot of it is language. A lot of it is terminology. Okay. Any other questions on this first set of learning objectives? So we just wanted to make sure you understand the difference between cash and accrual. And another thing I brought up the very first class is that you got to remember that we've got different set of books for financial reporting and tax as well. So there are differences between cash accounting and GAAP accounting. There are differences between cash accounting and tax accounting and GAAP accounting as well. All right, so let's go to the next. Our next learning objective in this chapter is now to think about the role of three more assumptions. Now, as I said, what this book does is it... Yes, you have a question? Oh. I'm sorry? Yeah, we mentioned that like the first couple of... Yeah. We don't talk about tax in this course. No, it's not. There are courses. Yeah, but there are courses for tax accounting. No tax accounting. It's a separate. If you're majoring in accounting, you will take a tax class, which is probably like 3 people. So. Okay. No, there are. I mean, seriously. There are different standards for different purposes, not only for tax, but also different industries. There are different standards. There's different accounting for banking than there is what you're seeing here. I mean, there's just different industry standards also. Okay. All right, so now these concepts that we're looking at, the time period concept, the revenue recognition concept, the matching concept, these concepts are designed to help you implement, or these are applications of the accrual basis of accounting. So let's do the first one. The time period concept is going to be something that you're going to need to think about when we look at the adjustments that we're going to need to make at the end of each set of financial statements. The time period concept basically means that we can artificially truncate the business into short periods of time. So obviously, investors, creditors, anyone using accounting numbers, whether they're tax numbers, getting back to that issue, or financial services, if banking, investors, creditors, you can't wait until the end of the life of the business to determine its net income. In fact, the only way you know your true profit is if you start a business today, stay in business for 15 years, and shut down. That's the only way you'll know your true profit. Because in accounting, we will be making lots of estimates. Brianna, you mentioned about accounts receivable. So earlier today, she mentioned something about how do you know you're going to collect those accounts receivable? Well, we don't always know when we make estimates regarding collection. So every year we'll make an estimate. So what if this year I think I'm going to collect 10%? And I write off 90% of my receivables. I say that 90% of my accounts receivable won't be collected. That could be a mistake. And what if I collect them all? So every period we're making estimates, and we'll find out that causes, or at least that causes us to make lots of adjustments as we move through this accounting process. So again, we can't wait till the end of the life of the business to try to come up with the actual amount of revenue and expenses. So accounting, as we said, is going to be useful because it's relevant, and it allows us to present information on a timely basis. And the timely basis means that we want to make sure that we provide information for taxes, and we provide information for the Securities and Exchange Commission. We mentioned one of the first things that we talked about was reporting under the SEC. 10K is an annual, 10Q is a quarterly report. Okay. So now, to satisfy these needs, we have to make what we call a time period assumption. So again, the time period assumption, formally stated, is that we will be able to truncate or split the life of a business into artificial time periods for purposes of reporting the economic activity in those periods. And again, what we'll do is we'll see that the accrual basis of accounting is going to be an application of the time period assumption. Now, here's an example. What if you had a business, and take a look at that calendar, and let's say that financial statements are prepared monthly. So let me put something up on the screen for you as well. So let's assume that you have a monthly financial statements. Okay, let me bring this in a little bit more. Okay. Okay, so you have monthly statements, and you pay somebody $400 per week in salary. Now, if you look at the calendar, let me go back to the calendar, will you? If you look at that calendar, the calendar says that October 31st is a Wednesday. So that means that you're not going to get paid until November 2nd. So when you look at this, if you ended the month on October 31st, do you still have salary expense for that person? Yeah. So you'd still have to come up with some way of showing the salary expense. So the way this would work, so this is the Monday, the Tuesday, and the Wednesday. Let me just repeat the calendar here. That's October, and November is the Thursday and Friday. Okay. So it's the 29th, the 30th, and the 31st, and that's the 1st and the 2nd. Now, if you're paying someone $400, that's the cash payment. That's the cash paid. But the question is, you have to prepare financial statements as of the 31st of the month. So you have to split that person's salary, and you have to reflect 3 days' salary in October and 2 days' salary in November. So in this case, if you think about it, you're paying that person $80 a day, and therefore you would have to come up with $240 of salary expense in October, even though you don't pay it until November.
Yeah, so you would only pay them on the 2nd, right?
Right.
They're still counting as if it was like something.
That's right. So the problem is by forcing us to stop the accounting period on October 31st, so I need to report on October 31st, it forces me to come up with a number for salary expense.
Is that why some businesses end their pay periods in the middle of the week? Because a lot of times they're on the
Yeah, I mean, sometimes they, you're never going to avoid to have some accrual of salaries at some point. You're never going to avoid that. Now, actually, if you looked at, if you're working and you look at your, your W-2 form at the end of the year, if you add up all your paychecks, it's going to have, obviously, you're on a cash basis, so you're only going to have what you received. But when you really think about the salary, you may not have collected that $400 yet, and that's not going to be part of your taxable income. But your book income, your GAAP income would have $240. And then, of course, in November, you'd have to have $160. So even though you get paid here, you got $160 in expense, salary expense. Now, again, I'll get to your question in a second, but remember, it's not the period in which you pay the salary, it's the period in which you get the service from the employee.
My question is, would it be as simple as that, Professor, where it's just like you would have to divide it, or like, let's say, Monday, Tuesday, and Wednesday, you work, let's say, 6 hours that day, and then Thursday and Friday, you might work 8.
Yeah, so that's a very good question. What would you do if the person worked different hours every day? Yeah, you'd have to get the exact records and use the exact salary records for those accruals. All right, but the point is, the time period assumption is going to force you to split salaries up, utility bills, and the like would have to be split in order to come up with the appropriate amount. Now, of course, again, not every company, and you mentioned about having salaries in the middle of the year. If you look at the next couple of slides, they just basically tell you, and this is pretty simple, that some companies have, not all companies have a 12-month year, right? So a lot of companies do not end on, a lot of companies' fiscal year does not end on December 31st. Rutgers year end, I think, is June 30th. Our first year, Rutgers fiscal year begins on July 1st. So in a lot of cases, there are, you don't have to have a year end that ends on December 31st. Now, when we look at the accrual basis of accounting, which we did in a little bit in the first learning objective, what you have to think about is that the accrual basis means that we're going to be recognizing revenue again when it's earned, recognizing expenses when it is incurred. And we will recognize revenue under something known as a revenue recognition principle. We're going to recognize expenses under what is known as an expense recognition principle. Sometimes it's known as matching. So when we look at this revenue, or I should say this expense recognition principle, it's sometimes known as the matching concept. And we'll show you what that means in just a second. Now, when you look at revenue recognition, it tells you in order to recognize revenue, you have to have an exchange, and the earning process has to be substantially completed. So an exchange means an exchange of goods for a promise to pay, an accounts payable. An exchange can be, an exchange of contractual promises. The earning process is essentially complete when there are no uncertainties as to future costs and to collection. Now, collectability, as we said earlier, that, if you have some question as to collectability, you would be able to think about how much you're going to collect to try to estimate that amount. The question now is, what costs do you have in the future when you sell a product? You sell a product, you walk away. Warranty, yeah. So a lot of companies will have warranties. Do companies have the ability to estimate warranties fairly well, do you think? Yeah, why? Yeah, well, past experience with the product. So they pretty much know how many returns they get, how many failures their products have. Sometimes they can't project it exactly. So generally we recognize revenue at the point of sale. Typically, the point of sale, people are buying the Apple phones today, so at the point of sale you recognize revenue, even though there are warranties there. And of course, Apple is estimating that maybe 15% of the total might have defects. That could be an estimate. They could be wrong. They could be under or overstating that, but they at least have a basis for a reasonable expectation as to what is complete. So we typically recognize revenue at the point of sale. We also say the earning process is completed when the seller performs all the needed services that they should. Now there's a question about that, whether or not a warranty is actually given at that point in time. So nonetheless, we recognize revenue generally at the point of sale. Generally at the point of sale. Now, just to summarize again, revenue is earned when the goods are delivered or the service is performed. That is a way to say that the earning cycle is, or at least as an exchange. Then you have the earning process being completed. And as we said, we usually perform, typically, when we perform the amount or when we perform the product or service, we're going to have the amount at the historical amount. So if you remember, we use this historical cost concept or this transactions concept. So it's typically the price you pay at the point of the transaction. That's the value of the services. So if a $200 item is discounted to $100, even though the catalog price says $200, it is the transaction price that you would record. So to summarize, you recognize revenue when it's earned. You recognize on the delivery or the exchange. The completion of the earning cycle is important, but for us it's typically the point of sale, and the valuation of the sale. The valuation of the sale is going to be the transaction's price. The transaction's price is the amount that is received in the exchange, or at least the amount, the agreed upon amount, which could be accounts receivable. So again, in this example, if you had a $200 item that's discounted to $100, it is in fact recorded at 100. It is the transactions price that you would record. And again, talking about those kind of tricks they have in these questions about, opening business, here's a perfect example. If they tell you that the catalog price is $1,000, but we sell it for $6, it's the transactions price that you must record. Okay. Now, the last principle here is this matching concept. And essentially what we would say is that we would try to recognize expenses in the period in which the related benefits are received. So the idea of matching means that if you have a sale today and there's a sales commission being paid on that sale, you'd recognize the sales commission in the same period as the sale. So you try to match the related expenses to the revenues that are received. So expensing a sales commission, as I said, is probably a perfect example of matching. Another example might be if you go out to see a client and you have to travel. You have to pay for, a plane trip. You have to rent a car. All of that expense would be matched against those revenues. Again, it's easy to see. Sometimes it's not so easy. Sometimes you have an insurance policy and, you'd have to wait really with the passage of time. So, for example, if I bought an insurance policy for my business, a 3-year insurance policy, and I'm recognizing revenue every day, I don't really try to take a piece of that insurance expense and match it against revenue. I would just take it monthly or every year. I would just take a 1/12 every month of that insurance and write it off per year. So again, you can't always match exactly, and insurance is a perfect example of that. So to summarize, you've got the expense recognition concept, and again, usually thinking of it as matching, that revenues and expenses are going to be matched. We recognize expenses when, of course, they're incurred, regardless of when they're paid. And finally, I got one question for you, though, before you go. And then, of course, here, I got a question before you leave, though. And in fact, I still got three minutes. So again, this ties together. This is a summary of the concepts. That the time period assumption, the revenue recognition concept, and the matching principle will be tied together as part of the accrual basis. All right, so one question before you leave. Let's take this one. It would ask you, revenue is said to be earned when the business has either entered into an agreement with the customer about the goods and services to be delivered, prepared the journal entry to record revenue, received cash from the customer, or delivered a good to the customer. So let's see the best answer here. Okay, we'll wrap up with this. And then, of course, I just want to make sure you get a couple of things straight before you leave, so don't just jump up after this question. And this is going to be an example of hold down, wait a minute, sit. Anybody have a cell phone open? What time is it, actually? Thanks. Everyone holds up cell phones, not supposed to have them open, that's okay. What is it, 2:18? 2:18, 2 minutes. Okay. All right. Okay. All right. So let's see why. Oh, wait. A lot of people have their cell phones open, and they tell me it's 2:18. Got 2 minutes. So, all right. And by the way, everyone that leaves early, we're gonna throw you out of here during the exam on the same time you leave every day. How, right? You know, for the exam, you're going to want more time, correct? 2 minutes. All right, so the answer here is D. Entering into an agreement, getting back to your point, if you just enter into an agreement, it's not going to do anything. The journal entry doesn't necessarily mean that revenue's earned. It could be, obviously, advance collection. You have a cash receipt from the customer. Again, that's advance collection. And D is the best answer.